Good morning, everyone. Oak Bloke here, and this is the first of potentially a number of webcasts that I'm going to do to talk through my 25 ideas. Might talk about a few other things as well, but let's start with those. And let's share my screen and let's get started. So I am sharing that screen there. And yeah, so we're going to start with let's just start with the ideas themselves. So I'm going to talk through excuse me, I'm going to talk through these ideas. So just talk through my thinking of building this portfolio of ideas. So what we see here is this is a subscription service called Stockpedia, and they give different holdings different scores, and 100 is brilliant and 0 is terrible. So it is one way that you can approach picking ideas, I guess. And I yeah, I mean, I've picked some that are super duper. As you can see, I've got one, two, three, four, five, I think. And I've also got quite a number that are contrarian. Um, Bearing in mind that this is the same idea that I'm leaning into in this set of ideas. So there's actually 35 rows to this list, and two ideas are going to appear twice. Oh, sorry, going to appear 6 times in the sense that I'm putting, let's imagine a £35,000 portfolio, £1,000 in each of the ideas, except for two, where I'm going to put six. So it's 12,000 on two, 23 on the rest, equals 35. Anyway, so some ideas are contrarian, some ideas are super, some ideas don't have a valuation or sort of a score. And they also have this style. So the sort of score and the style tend to go hand in hand, as in things that score lowly are called suckers, and things that are sort of not so low are called traps. And but my experience last year, I picked four that were suckers. I mean, yes, one did go bust, so perhaps there was, but fantastic commercial idea, and the company that's bought the assets doing very well with it. So I think there's a difference there between the idea being a bad idea and the execution of the idea being unsuccessful. So and that actually brings me on nicely to these columns over here, that as well as sort of looking at the ideas and saying, well, what could I see this doing by the end of 2025? What what would be what would be the whole point of having it as an idea? Like, where's the upside? So I've as you can see, I've given it an assessment. This is just my personal assessment. Everything that you're seeing here is all just my opinion. It's just shared with you for information and for entertainment, as the saying goes, and you make your own investment decisions, of course. But yeah, what I've done here is I've said, well, what do I see as the potential upside? But then let me moderate that with three types of risk. And I've created an assessment of high, medium, and low. And I've said performance risk. Performance risk being this could just not perform. It could not work out. So, for example, here, distra- excuse me, distressed debt, excuse me, I've assessed as a low risk. And we'll talk about this holding straight after, but low risk in the sense that this idea, or this distressed debt, was distressed many years ago. So here we are many years later, even though it has the title distressed debt, it kind of isn't. So to my mind is actually quite a low risk. Whereas something like, say, for example, EMV Capital, I mean, these are groundbreaking ideas that will change the world, but part of being a groundbreaking idea that changes stocks. Um, these ideas are by their nature just higher risk, and then risk somewhere in between. And I've given that a medium risk because of where it is in the world. Nigeria, it's not. In some ways, it's not a risky jurisdiction, and in other ways, it is, in the sense that corruption is high. But the desire of the federal government in Nigeria was also high to encourage new forms of economic growth, and in this case, gold mining. So anyway, that's the thinking. So the risked return is basically, after I take these considerations into account, what could I be left with? And again, this is just my assessment of where I sort of see this going during 2025. And then we've got a type, and I've been doing a little dry run here of from when I produced the idea, what's it doing ahead of 2025. So I'm just sort of keeping an eye on it. Obviously, some of these have fallen in price during 2024. So somebody that wants to race against me in 2025 can probably look at this and go, oh, yeah, Bloke's at it again with his speculative stocks. So we'll see on that. We'll see what 2025 brings for these. And I'm very optimistic about their year-to-date performance, and hopefully these 25 videos that I'm going to record will just give you a bit more of a flavor beyond the words that I've written on an article as to why my conviction is what it is. Anyway, let's dive into this one. So this is the distressed debt is from Neuberger Berman. These guys are a very large fund manager, global fund manager. So the distressed debt is in wind down. So I'm on their website page, and you've got sort of different news flow, investor information, fact sheet. So the level of detail and the level of disclosure is actually quite limited. That is a consideration with this one. There's also slightly strange, or at least what I considered slightly strange, graphs so for example here, something that says even in a favorable scenario you're guaranteed to lose money, which especially if you hold it for 6 years. But I kind of wonder what this is based upon, because this is in wind down and it's very unlikely that these holdings are going to be around in the year 2030. So quite whether this is sort of written in 2018 predicting 2024, or what timescale it's over. I mean, I've just concluded to ignore it really. Anyway, let's get into the article. Yeah, I mean, it was a reader idea. Reader idea said, they think is the best, and I said, yeah, I'll take a look at it, and it seemed quite interesting. I mean, although I must admit, when I first had distressed debt, this is a great example of when you look at the name of the tin, you might come to one conclusion. A superficial analysis would perhaps naturally lead the average investor to say, oh, well, I'm not interested in taking vast amounts of risk investing into distressed debt. But when you actually get into the detail of these, I mean, these are funds that were about 12 years ago. I think is the newest, and the oldest is about 16 years. So they've been around for a long time. They were distressed debt back in the day, back in the 2010s, or even in the noughties. And so yeah, I mean, I suppose my point in this article was to say, well, look, yes, I get what you're saying about distressed debt being, problematic and risky, blah blah blah. But I just would say have a look at what's inside, as opposed to. And these guys, 481 billions in assets. we're not talking about a kind of we're talking about quite a credible investment manager. And so when they say, um, when they give you a reasonable assessment, I guess your reasonable assessment has to be, is their reasonable assessment sound or dodgy? And what they do actually do is they give um, a kind of best case, worst case, and a sort of expected case. So yeah, I mean, I guess what you have to do when sizing this up is, what's your chance of getting your money back? What's the chance of a turnaround? So the whole point of taking on a distressed debt, if you're not aware, is that it's essentially private. What you're investing into is kind of on the strictly. So the question is, well, does a fund manager coming in, maybe some extra money, some ice for the head, or whatever metaphor you want to use, can they turn it around? And actually, more to the point, have they turned other things around? So that was quite interesting. That was perhaps one of the first things I looked at was, well, what track record have we got here? And the track record was that they, and it's just down into this part here, the IRR that they'd achieved across all the funds was that they'd actually returned more capital than the initial outlay. So they delivered a positive return to earlier investors. So that to me was quite a positive, and also that um, they'd managed to make some form of profits. So what we're left with is three different funds, and I looked at all three of the funds. And these funds are in wind down. So I kind of looked at the a couple of metrics really, and you can see them here. I looked at the spread, so spread being the difference between the buy price and the sell price. So these spreads are quite large, as you can see here, between 13 and 18%. I mean, that's quite off-putting for a lot of people. They'll say, oh, like the minute I buy it, I've lost at least 13% of my money. I've got to make, when you lose 13, you've got to make 15 or 16% to get yourself back, because it's markup and margin. You lose the margin, and then you have to make the markup to get back again. So that's quite off-putting, but that in itself can sometimes be that, because it's off-putting, that it's unloved and nobody wants it, and and then the next thing to then therefore kind of ask yourself is, well, what sort of discount am I going to get for taking on this unloved thing that says distressed debt on the tin? So it's unloved because of what it says on the tin. People, it's like sort of saying, um, oh, would you like a tin of sardines? And people go, ugh, sardines. But then if you go, oh, would you like a tin of pilchards instead? Oh, pilchards, that sounds good. And it was the same with crab. Cornish crab used to be called something else, and they renamed it Cornish crab to make it sound appealing. Oh yeah, Cornish crab. Oh yes. I think it was it'll come. Yeah, maybe we should quickly look it up. Cornish crab rename. Spider crab, yes. Would you like to buy a spider crab? Ugh. Nobody's going to want to buy a spider crab, but rename it a Cornish king crab. I missed out the king. There we go. You can tell I don't eat spider crab. Um, you know, Rename it Cornish king crab, and all of a sudden people will buy the thing, because all of a sudden, oh yes, that sounds marvelous. It's from Cornwall. And you just get like that whole sort of episodes of that um, chef and so on. It's Rick. I forget his surname, but he's an excellent cook. Anyway, we digress. Um, We digress. I digress. You don't digress. I digress. Anyway, so yeah, what's the discount? And then this one came out clear. So I just traffic lighted it for readers. You know, this one's 44%. You're getting more than double the discount of this other, you know, these other pair. How much of these are already in cash? Now, obviously, this one traffic light the best. My next thing to do then was to say, well, okay, let's strip the cash out. What discount are we left with? Now, this one obviously just because it's lower level of cash, that one was only jumped by a few percent, whereas this one obviously jumped by a lot more. But even, you know, because of this larger discount to start with, this cash sort of meant that it was still on the larger discount. And actually getting into the detail of all of this, you know, the NB people, bless them, don't make this obvious for investors. But actually, when I read this and I kind of reread it, I went, oh, hang on a minute. This one is 15% cash, but distribution received in respect of asset sale. So it's not 15% of 55p, 8p of cash. So actually, that's 30%. So that is actually above 50. So actually, when you throw all these little things in, it's shone through as the one to go for. And then the next thing, and in their fact sheet, I think it is, that they say, well, look, there's a worst case, a best case, and a base case scenario. So worst case, their assessment, and notice I say the word assessment. You know, I've got no way of validating their assessment beyond it's their assessment. So you've got to just be happy that a 481 billion asset manager, when they tell you its bear case is 92%, you kind of go, okay, I trust you on that. And that's all I can say on that. I mean, you know, somebody said to me, oh, well, you know, a reader said, oh, well, I think they commented, oh, well, you can't see what the assets are. I said, no, you can't. That's just part of this idea. But look, I mean, worst case scenario, and let's just chuck that up on screen. The worst case scenario is basically if we take the bits that if we take the you know, this N6, which is the worst case scenario of 55.76p, and there's 73% being that bit, and that bit. In other words, this one here, let's exclude that one. 73% of the bear case is 37.4p. So if you're buying it at 33, now I actually, when I bought it at 32.5. I actually got it below the ask. You know, the spread was smaller than the official spread. So you know, to my reckoning, I looked at that, said, well, look, this is kind of pretty much a nailed on 15%, 15%, plus a further 23% transport. So kind of almost like the worst case scenario to this is that you kind of get 37.5p back, and then you've still got an asset left, and who knows, I mean, that, let's say that even if that's half price, let's say, so you know, 11.5% of 55p, that's then another 6.3p. So you know, you're looking at 44p worst case, as long as you believe their assessment. And that assessment, by the way, I've just done 50%, not 92%. So I've actually gone lower than their assessment in that 44p. But best case, I mean, again, let's just chuck it up on screen. Best case scenario, I mean, that was the base case, that you would make 74% return. So that's basically taking the 103 times that, minusing off the 33p that it's costing you in the first place. But let's just swap that out for the best case outcome, and you've more than doubled your money, 115%. So all I'm doing is I'm saying, take the best case scenario that they're telling me could happen, take the value of the NAV, multiply that through, and that's the result, 115. And I mean, who knows, maybe this litigation, awaiting results of litigation, I mean, it is a result of litigation. They're not waiting to start litigation. Obviously, you've got to read into these words again. You don't know definitively, but yeah, you're awaiting the results of litigation. So that will unlock the escrowed proceeds. So the escrowed proceeds tell me, well, there are proceeds. They're just locked away. They're escrowed. Escrowed means they exist, but I can't touch them because I don't yet know the outcome of the litigation. And again, I've got to just trust that this 23% is their fair assessment of what the value of those proceeds for investors would be. And you know, they don't kind of nuance this against each one of these assets, which would be nice. Personally, if I were the fund manager, perhaps I'd want to kind of nuance it. I think nuancing it would not be a bad thing to do, but you know, I don't run a 481 billion fund, far from it. And what do I know? But that's yeah, that's kind of so yeah. Look, I think to conclude, as I say in my article, NubDug is the clear winner. Oh, I need to change that now to 25 because it started as 20 and I got greedy, and well, either that or I just wanted the extra work of an extra 5 ideas. So I will amend that to be the 25 for 25. Yeah, so look, you know, that's why I said it was a rapid, attractive, fairly rapid return. Oh, by the way, sorry, I didn't point this out, but 1H25 and then next 6 months. So yeah, you know, the other point to say about this is that you're only really waiting for 62%. This 15 already has come through. So I actually got back I think it was just over 6.5 pence earlier this month. So obviously, if you've kind of missed the boat on that and didn't go with this idea, I think yeah, I think the cut-off point was the end of November, and the 6.5 pence came through in week 2 of December, I think it was. So, but look, I mean, even if you've not taken advantage of this idea, is it still worth it? A couple of things I'd say is, bizarrely, it's gone up in price. It's gone up in price from, I think it's now at 29-35. So the economics are slightly lower, but as you can see, I mean, could you double your money on this? Potentially. Could you lose money on this? I mean, yes, potentially. If you believe their assessment, even their worst case assessment, the answer should be potentially no. You know, on paper, in theory, and I stress that it's I'm just working with the facts that are being presented to investors. That it appears that the odds are in your favour with this idea. So look, I hope that's been useful to talk through. Just want to end by mentioning Emmaus and the work that these guys do. If you're enjoying the articles I write, if you're enjoying this video and other videos that I'm going to produce, I'd like you to consider, you know, giving something back. It's Christmas time. It's cold outside. Really appreciate it if you would contribute to the campaign. This campaign's really, I mean, I'm absolutely so delighted by the response from us. And we're at 2072 plus gift aid, so we're at two and a half, which is fantastic. Now the way that Emmaus works is that they in terms of people they help, I mean they're not a vast charity. They've got centres all around the UK, so go and look at this for yourselves. But they are dotted around, and they've got sort of different local Emouses that do everything from sort of furniture shops and coffee shops and different things. So but they help several thousand ex-homeless. They're ex-homeless because they're as part of being helped by a mouse is that they have a roof over their heads, but they have a job and they have to contribute and give back. It's not just sort of a handout; it's a hand up. But what a mouse also do is just some work around. Um, helping people help them do a training course, help them pass their driving test. It's all of those catch-22 things that stop people from being able to just get their lives back together again. So look, really appreciate you helping. If you are one of those that have, if you're not, please do help. Really would appreciate you putting your hand in your pocket, and thank you for watching this video. Would welcome any feedback, good or bad. Yeah, I'm sure there's before too long I'll be getting some harumphers on here. So yeah, look, this is the first of 25. So assuming that this is a useful format, I'd be interested to get feedback on whether it is or isn't. I mean, at the end of the day, I'm only really reading out my article to you, so um, that perhaps it's not that useful. I don't know, but you tell me. Cheers for now.